Time now for today's strategy session. The $29 trillion bond market is seeing its rally continue today. As Fed Chair Jerome Powell, well, at least it was seeing its rally continue. Fed Chair Jerome Powell tries to ease growth and inflation concerns. So what's the bull and what's the bear case as the bears are having their way, at least early out the gates this morning, for the markets as investors and the Fed grapple with growing uncertainty? Joining us now, we've got George Catrambone, who is the DWS Group Head of Fixed Income and Head of Trading here. So you saw the market action that we're seeing in the bond landscape right now. Why do you think that's playing out post yesterday's Fed announcement?
It's the reaction of Powell. He was great yesterday. One of his better press conferences. 10-2 on the steering wheel, middle lane, keeping up with traffic. And, I guess really doing a good job from what people were worried about going into this, which was that, yeah, of course, unemployment may go up, inflation may go up, growth may come down. What about those cuts? And leaving 2 cuts in that dot plot, I think, is what relaxed everybody and really calmed the bond market from where we were going in.
You laid out a bull and a bear case for the market in your notes over to us, which gave me a lot of clarity. And what is the only thing that's certain is the uncertainty right now.
That's right.
Can you walk our audience through that bull and bear case, and which of the two you think is more likely right now?
Yeah, look, right now, from a bull perspective, unemployment rate is only at 4.1%. We had 150 in payroll ads. Capital markets are functioning. IG spreads are pretty tight. So it's really not that bad. And right now, the soft data could be head faking that hard data. So I think that's the bull case, that we've seen these kind of spooks before. We saw NFP in Q3, CPI in Q4, and now Q1 we had this sort of growth scare that's there. So it really could be a storm in a teacup. And we had a negative GDP in Q1 of 2024 as well. And look how that year turned out. The bear case is this is a K-shaped economy that we don't have any more pricing power left. The consumer is really shot, and now this uncertainty is forcing companies to pull back, consumers to pull back, and there's really no fiscal impulse this time around with Trump and the kind of the cutbacks that are happening with Doge and in government spending and otherwise. So yeah, those are the two sort of bull and bears, and no one really has that certainty and clarity right now. Maybe Trump does, but that's what you're seeing in this push and pull right now with the market.
And so with all of this, I'm focused in and I'm locked in on what we had on the screen a moment ago in the 10-year, because that 10-year is more tied to mortgage rates, and shelter has been the stickiest portion of inflation. Are these moves material enough for there to be some easing in the pressure that we've seen from the shelter component side as the Fed is reading through and trying to best gauge what their next step should be?
Well, it's been coming down. And if anything, goods has been more of a concern in Powell's press conference yesterday. So it's slow. Shelter and rents tend to reset every year. And Trump and Bissent is the world's largest bond salesman. That's why they're very keen to bring down that 10-year benchmark rate. And it's come down most weeks that Trump's actually been in office. And I think that's their priority, is to get that down to help housing and understand that shelter and our housing markets are a large part of our overall economy.
Talk to me about this line in particular, about where manufacturing is heading in the U.S. You said, I'm not sure the U.S. can structurally become a pure manufacturing economy unless wages nosedive.
Yeah.
Would that force the Fed's hand if we do see a nosedive in wages?
It could. We're just not this Rosie the Riveter kind of situation coming back like Trump may project with this 3% productivity and production kind of coming back. I just think structurally where wages are, and right now where we are, and especially in cutting off immigration, that's ultimately a headwind to coming back to that. Now maybe in the AI, and that was sort of the hope until DeepSeek kind of came along, and we'll still see where that goes. So if you're looking for that kind of manufacturing to come back, I think it is in the AI sector, it's in data centers, and it's in that area. I'm not sure it actually comes back to manufacturing. You and I have talked beige book in the past. The manufacturing looks so bad. Global PMIs and PMIs are above 50, so there's something to that. I don't know about getting all the way back to where we were again as a manufacturing powerhouse.
Where does the U.S. exceptionalism trade sit within the fixed income landscape right now?
Well, for the moment, we're passing the baton over to Europe because that's where the interest has been. That's where yields have gone a little bit higher. And that's where the spending is right now, right? Fiscal is coming down here and theoretically going up there. So for the moment, we're going to take a pause and hand it to Europe. But there's another structural question for me. Will they be able to actually ramp up their production and productivity in a way, or will ultimately the money funnel back here?
We don't all have the same AI?
Not only do we have the same AI, but the same manufacturing as it relates to defense. Like Airbus can only do so much.
And final 30 seconds, George. One of my questions to you on set was the global demand we're seeing for U.S. bonds. You actually think that's not a huge risk to the U.S. economy?
It's not. And there's plenty of room for the Europe and the U.S. to be there. And I think from a Treasury perspective, this question comes up a lot. And foreign demand has been coming down all along. So I don't think that's been a major headwind, and auctions have really been behaving thus far. So keep an eye there, but until auctions and bond vigilantism comes back, I'm not concerned.